testing the controls over those transactions. So you see the term test the transactions, test the controls. So tested transactions and tested controls usually happen simultaneously. Whereas with the balance sheet accounts, you're performing substantive procedures, right? Substantive audit procedures. And so, for example, a substantive audit, Ricardo.
You were going to answer my question. I was going to ask you to develop more on, sort of give us a general overview of what substantive procedure is.
Yeah, so that's what I'm going to do, right? So your substantive audit procedure, right, is you're testing the details, the account details. And so the detail test, so you sometimes see it is referred to test the details, test the detailed account balances, and so forth. Those are substantive procedures. So for example, with accounts receivable, you want to test that accounts receivable exists, right? Because the fact that you recorded a sale and you've tested sales, right, and you are satisfied with the transactions and controls over the transactions that create revenue. That doesn't tell you anything about the collectability of accounts receivable, right? Or that the accounts receivable exists. So it's not, you cannot just rely on those tests that you perform on sales to satisfy accounts receivable. Your ability to conclude on the accounts receivable balance. So substantive procedures would be to ensure that accounts receivable exists. The most common audit procedure is to confirm. And in fact, it's a required audit procedure. Auditors have to confirm accounts receivable. And if they don't confirm accounts receivable, they have to have a very good reason as to why they don't. Okay? So you're required to confirm accounts receivable. And basically, confirmation of accounts receivable is you select a sample of accounts receivable and you confirm with the customer directly. The auditor confirms directly with the customer the account balance. If the customer comes back and say, yes, we owe XYZ company $100,000, then you've confirmed the account balance. And you've basically said, yes, this accounts receivable exists as of 12/31. Right? So is it clear to everyone why testing controls and testing transactions will not give you evidence about accounts receivable? It'll only tell you that that accounts receivable was valid when it was recorded, but it doesn't tell you anything about the existence of accounts receivable at 12/31. So here's a question I have you. Let's say the company sold goods to a customer on March 31st. 2013. You come in to do the year-end audit and let's say it's February 2014. That accounts receivable is still on the books. What would your conclusion be? Yes, John. Right. It's been almost a year, you haven't collected on it. So they're not going to pay. So what would you recommend as the auditor? Right. You would recommend that it should be reserved for. You're not going to collect. You would go to the client and say, this has been outstanding for over a year. This should be, have you reserved for this? Are you going to collect on this? Right? So at a minimum, you're going to expect that that amount is reserved for in the allowance for doubtful accounts. You might suggest to the client that, question the client as to why they would not write the receivable off, or what efforts do they have in place to collect on the receivable. Right. So was that a valid accounts receivable? Yep, it was a valid accounts receivable when it was created in March of 2013. But now the question is it collectible? That's the valuation and allocation. What's the likelihood that the company is going to collect on that accounts receivable? If I'm here as an auditor February of 2014 and the accounts receivable still hasn't been collected on. Because your normal cycle for accounts receivable is probably about 30 days, right? Most companies will extend credit to their customers for maybe 30 days. Okay. So confirm a sample of accounts receivable and perform follow-up procedures. And the follow-up procedures that you're going to perform with accounts receivable is, one, you're going to confirm it. If the customer sends the accounts receivable confirmation back saying, great, yes, we owe them, our records show that we owe them 100%, check it off, it agrees. The customer might not send it back. What do you think you do if the customer doesn't send it back? If they don't confirm the accounts receivable, what do you think your options are as an auditor? Yeah, you have to perform other tests, right? You can't just say, oh, the customer didn't confirm, so I'm going to pick a different customer and confirm that customer. It's not pick and replace, right? Can't do that. You selected that in your sample, you have to follow up on it. So you have to perform alternative procedures. And those alternative procedures would involve you looking at subsequent cash receipts. Because remember, you're confirming as of 12/31 if that's the company's year end. You're looking at the accounts receivable balance as of year end. So really, if you're coming in a couple of months, 3 months after year end, the likelihood of it is that that accounts receivable should have been collected, right? That they might have cash collections against that accounts receivable at 12/31. I mean, as of the audit date. So you would look at subsequent cash collections. Or you would look at whether or not the company's going to, or you can get a confirmation back where the customer says, no, we don't owe 100,000, we owe 80,000. So that is, you're not going to send another confirmation and say, oh no, we say 100, why is it 80? You're going to follow up on what's the $20,000 difference between what's recorded and what was confirmed. So that's what we mean by follow-up procedures. You're also concerned about the accounts receivable is accurate, so that's just a matter of, what creates accounts receivable is sales. So you tie the accounts receivable information back to the original sales invoice or and shipping documents. Rights and obligations, you're going to look, you want to ensure that management actually has the rights to the accounts receivable that they've recorded, that they haven't factored accounts receivables or sold their accounts receivable to a third party. So in that case, that information has to be approved by the board. Normally that's going to be a board action. You would look at board of director minutes. You would ask the client, management inquiry, ask the client, have you sold or factored any accounts receivable? Look at documentation. If they have sold or factored accounts receivable, look at the contracts related to that. So those are the procedures that they would perform. You would also see sometimes too by looking at the bank confirmations during your bank, when you confirm the bank cash account balances. Part of that confirmation asks, are there any loans or liens that the bank has with the company? So then you'd look to see if there's any indication that would suggest that the company has factored accounts receivable. Completeness is all receivables that should be recorded, have been recorded, and when you perform the sales cutoff test, that'll give you information about accounts receivable, the completeness of accounts receivable. Another thing you can do is include a sample of zero balances in your confirmation account, right? So if you, from your accounts receivable subledger, right, you could just send to the customer asking them to confirm their account balance as of 12/31. And if the customer comes back and basically says, we owe $500, but the client is saying it's zero, that means that you would follow up on that, and maybe the client forgot to record an accounts receivable. So you could do that as well. And then valuation and allocation obviously deals with whether accounts receivable are recorded at its net realizable value. So here you're going to test the age trial balance. You're going to look at whether or not the aging that the company has and the amount that the company has recorded for allowance for doubtful accounts is appropriate. You'd also look at any write-offs that the company is engaged in. Also, when you're doing your planning phase, you're going to gather information about the customers, the company's customers, any major customers. If there's been a change in how their customer base, right? For example, if they've moved from maybe selling to a lot of smaller clients to selling to much larger clients, how might that change? How might that change your allowance? How you look at the allowance for doubtful accounts? A lot of small clients versus several major large clients. How might that impact your assessment? So let's say the company changes its customer mix. So they've moved from selling to a lot of little small business type customers to larger companies, corporations.
How would that affect the company's financials?
How might it affect the way you assess the allowance?
Well, you have to obviously assume that your sales rep, you're going to sell more product or whatever.
Maybe.
Maybe expect an increase in AR.
So it could be an increase in AR, but how might that impact allowance though? Victoria?
With a big customer, there'd be more day-to-day, and that could be more mistakes caused in there. Like if there were problems to occur, it would be easier to slip into one of those smaller sales.
Okay, so, and how would that affect how you view allowance for doubtful collectability? Yes.
Wouldn't it decrease because of all it's on bigger customers?
Right. So you would probably see more of a decrease in your allowance, right? Because larger customers, as you pointed out, Victoria, they're engaging in a lot more transactions, but they're paying, right? Bigger transactions, they're paying. They usually have systems in place where they're paying on a regular basis. Less chance of bankruptcy per se, right? When you have larger clients, corporations, because they're not, your business is not such a huge part of their business, right? Because they're large corporations. So that would probably result in a change in how you would reserve. You'd probably see a smaller allowance for doubtful accounts or a lower reserve for uncollectible accounts in that case. The other hand, the other risk though is if you have a lot of small clients, the loss of one client a customer I should say, doesn't really impact the business as much because you have a lot of small clients. But however, the risk is greater when your business is concentrated with very few major companies, right? Because if you lose that company or you lose that business, that can have a tremendous impact on your sales. But also if that company goes bankrupt, then that has a tremendous impact on your accounts receivable and your ability to collect. You're probably not going to collect on it. Right? So an auditor has to consider both sides of that when they're evaluating the allowance for doubtful accounts. Okay. Any questions so far about